Let's see what Peter Dixon is expecting from the day ahead. He is a global equities economist at Commerzbank. Peter, thanks very much for joining us. What's your prediction for this figure coming out in a few hours' time?
Well, for what it's worth, given that this is a very volatile figure, we're looking for the headline number to decline by 100,000, which isn't that far off from the consensus figure. We have to bear in mind, of course, that there's been a huge amount of temporary hiring to process the decennial US population census, and a large number of the people who were employed to process the census will be dropping out of the figures in June. So what we should be looking at really is private sector job creation, which is expected to be up 150,000. So that really is an indication, perhaps, that the US economy is a little bit stronger than the headline payroll figure will probably imply.
So are you quite confident that jobs are being created, that enough jobs are being created to push the economy forward?
Well, that's a slightly different matter. Yeah, jobs are being created. I think it's a very moot point as to whether they're being created at a sufficiently rapid pace. I mean, if we get 150,000 private sector payrolls in June, I mean, that will mean that approximately 645,000 new private sector jobs have been created in the first half of 2010. Bear in mind that in late 2008, early 2009, we were losing that many jobs per month.
Right.
So we're still way below the number of jobs prior to the recession. There's a long way to go.
Now, we've heard quite conclusively from the Fed that they won't be raising rates soon. But what kind of influence does this data have on a decision longer term to raise rates?
Well, to the extent that the Fed has an unemployment mandate, if we don't see the unemployment rate falling at a particularly rapid pace anytime soon, that's going to further delay any chance of the Fed raising interest rates. And I think our guess is that with the population growth in the US continuing apace, with job growth not really doing very much, unemployment's going to remain high for quite some time. And as a consequence, the Fed is not going to be jabbing on the brakes anytime soon.
Now, of course, there's been a lot of talk about a double-dip recession recently. What is your take on that? Do you think that there's any chance that we'll go into a double dip?
It's not our central case, let's put it that way. I mean, we'd certainly give it a less than 50% probability, but certainly a slowdown in the rate of growth over the course of the next 6 to 9 months can't be ruled out. And I suppose from a market perspective, that is something which would be viewed very negatively.
Now, turning now to the eurozone, facing similar problems over job creation, are there many parallels between what's going on there and what's going on in the US right now?
Well, on the surface, yes, but I guess if you look below the surface, the situation is rather different. The US shook out a huge number of jobs due to the fact that the economy took a major hit, and because the labour market is that more flexible. So you might expect that as the economy picks up, so the US will create jobs at a faster pace, albeit on a longer-term horizon. In the eurozone, I think the situation is rather different. The rather institutionalised nature of the labour market means it will be very difficult for firms to continue to create jobs if they want to remain profitable. So I think we're going to be stuck with high unemployment in the eurozone for some time to come. Yeah,
indeed, and we're looking at austerity measures which are going to shed yet more jobs in the public sector. How convinced are you that those austerity measures will work and won't slow growth too much?
I think there are major question marks surrounding that. It's not just that we're doing this on a one-country basis. It's almost a global phenomenon. We're seeing certainly austerity measures across the whole of the eurozone, and I think we'll see additional austerity measures coming out of the United States. It's what Keynes called the paradox of thrift back in the 1930s. In other words, what might be good for one individual, when done on a wider basis, is certainly bad for the economy as a whole.
Peter Dixon from Commerzbank, thank you very much.